Hi everybody, I hope you're well. Look, I just thought I'd send a quick video rather than an email, which can be a bit wordy and a bit hard to digest sometimes. But to address the matter of the RBA official interest rate rise from yesterday, while it was expected and has been expected for some time, it's the first time the Reserve Bank's increased rates for around 12 years. So it's garnering a lot of attention in the press, of course, and with that comes a lot of discussion, a lot of information, some of which is helpful, some of which isn't. So I thought maybe a quick email to simplify and clarify things for you might be useful. The rate rise, as you probably know, took rates from a very, very low, historical low, 0.1% to 0.35%. First time rates have risen in 12 years, as I said, but again, it is not unexpected. The increase has been on the cards for a number of months, and those who watch their accounts closely or come in for reviews in that time will have noticed that balances have tracked sideways or even gone back a little in the past 6 months or so. And what it means too is that interest rate rises affect share markets as well as those defensive bond markets that so many pre-retirees and retirees rely in their portfolios to smooth out volatility and give them some moderate kind of return. The Reserve Bank had said for some time that they would wait to increase rates until inflation stayed within that 2% to 3% band that they target. And this would probably only come after a period of sustained wages increases primarily. However, while that was their notion originally, things have developed a little differently to expected, and last week's inflation rate in Australia of over 5%, and it's higher in other countries around the world, I think it's twisted their arm or made them take the move probably a little quicker than they ideally expected to. But I think it's important too to remember in all of this that this is all on the back of a strengthening economy, a recovering economy, and that's something we all wanted and were looking forward to. If I could read one quick paragraph from Philip Lowe from the RBA, his announcement yesterday as he made the rate rise. He said that the central forecast is for Australian GDP to grow by 4% over 2022 and a bit less, 2% in 2023. Household and business balance sheets are in good shape generally. And the upswing in business investment is underway. There's a large pipeline of construction work to be completed as well. So the economy is looking stronger, and this is typically the way it works. I think it's important really then to consider the impacts, because that's what we see, you see, I see in our superannuation funds, pension funds, investments along the way. Again, I noted earlier that shares have been quite volatile, and that's the market that gets a lot of attention on the little charts that come up at the end of the ABC News and whatnot. And with that, the markets essentially have been expecting this interest rate rise, and it's built into the investment markets. So these rises have been anticipated. It's now a matter of seeing how many come along, how fast they come along, and to what extent. So the good thing, I think, is that it can be done in a calm way, because the Reserve Bank makes an increase of 0.25%, and then there's a period where it can wait and see what happens and make another decision the next month. I think what's important to talk about is the impact of interest rate rises on defensive investments, those government bonds, company bonds, those kinds of securities that many people, typically in their pre-retirement and retirement phases, rely upon to give their portfolios some diversification and to take some of that volatility out of the portfolios that shares bring. As such, less volatility, less risk, lower return expectations. So these fall somewhere between cash down here earning next to nothing in the bank and shares up here earning 8 to 10 to 11% per year on average. Now, the concerning thing for clients with bonds is that in these past few months, you will have seen net negative returns on the bonds, and that can be quite rattling when the purpose there is to smooth out volatility. But it's important to recognise a couple of things. Number one, we have bonds in there to diversify. So they'll react differently. They'll earn a small rate of return, even when capital valuations, which is what we've seen lately, are having a negative impact on the overall value of the bond. What we see is that the yields have risen fast, and that's been a factor of all this discussion around the rate of inflation, and it's whether or not it's significant or sticky, sustainable inflation. And the rates have risen quite quickly. So what it means is that, like a share, it affects the valuation of the share, of the bond. But that's only a real loss if we then sell the investment partway through. What is important to remember, though, is that these periods of repricing that's happening now also present a higher return prospect for your bond investment managers. So they're always getting cash flow in, and they're getting cash flow from new investors and also from the income from existing bonds they hold on your behalf. And this new money then is available for investment into new higher opportunities. For example, VW, the car manufacturer, has released Australian bonds recently, 3-year bonds at a yield of 4.04%. So we can see that we're getting back into that newer, better returning environment, but it takes this transition period for that to kick in. So I guess all of that in a nutshell is that this volatility we're seeing in shares, in bonds, is to be expected, is manageable, and again gets down to how the portfolio is set up, so that for the purpose of the portfolio, a longer term investment, we can sit through it. Where income needs to come out, retirement income needs to come out, we need to have provisions in there. And again, it's a bit of a plug for making sure we have our regular contact reviews, that kind of thing, so we can reassess the situation, circumstances, and see how the portfolios need to be set up to manage that as well as we can. I hope that's been useful. I hope it's made sense. As always, give me a call if you wish to discuss anything. Send me an email. Otherwise, I hope you're well. Take care, and we'll talk soon.